As investors and developers, we see the world differently. This podcast uncovers the untold truths of what it really takes to become a multi-million-dollar residential developer. I'm Nathan Battishall. Let's get to work. Well, welcome to another episode of the Residential Developer Podcast. I'm the host of the show. My name's Nathan Battishall, and I'm really privileged today to have a special guest all the way from Brisbane. They also have an office in Sydney, but it's an honour and a privilege to have Tony Lee from Lee & Lee Accountants with us today. Now, Tony is an absolute specialist when it comes to investment development, working with developers and investors, especially doing long-term hold projects and also working with your self-managed super fund. So we're going to do something a little bit different today in this session. Rather than a Q&A, we're actually going to jump across to Tony. He's got an incredible presentation that is perfect for anyone doing projects and wanting to generate long-term wealth and build a lifestyle through wealth. And this is an incredible presentation. So I'm going to hand over to Tony, and he's going to run you through this presentation. I encourage you to have a pen, take notes. It's interactive. Obviously, this is a very visual presentation. So if you are listening on Spotify or Apple, I encourage you at some stage jump across onto our YouTube channel as well, where you can physically watch this presentation, because the slides that Tony is going to present are very interactive and incredible. So I'm going to hand over to you, Tony. Maybe just tell us a little bit about yourself, your background, your company, and how you help investors and developers.
Yes, thanks very much, Nathan. I'm super excited to jump on this special podcast, be a special guest speaker to you guys. Lee & Lee. So who are we? We are actually an accountant, right? Please, don't hold that against us. We're not your typical accountants. So we are actually, as you mentioned before, we are actually property tax expert, a business strategist and SMSF specialist. So as an accountant, we actually really passionate about helping property investors, property developers, small business owner to first and foremost to build their wealth, but also protect the asset, the hard-earned money that they actually built through obviously property investing, and at the same time, having a good fun out of it and minimizing tax and keep their ATL happy or out of fear from you. Yeah, so basically, I guess as an accountant, over the last 20 odd years, the first thing that we'll do is just any prospective client coming to see us, we actually do a what we call honest conversations or a free review, just to give you a second opinion about where you're at now, where you're going, have you got the right structure, are you paying way too much tax? And here's the thing, Nathan, most often, the first thing that we do in terms of conducting a second review is that we found that overall 9 out of 10 that we've seen, it's either a client got an incorrect structure or pay way too much tax. As you always probably mentioned before, either they got an incorrect structure or alternatively, they're paying way too much tax. Yeah. So as an accountant, we just super passionate about helping our client and investors, particularly in property investing and development, to structure correctly so that you can actually keep a lot more of what you're creating into the future for your financial retirement. Yeah.
Brilliant. Love it. So
I'm going to probably jump on the share screen now. And as you mentioned, I probably this time's a little bit slightly different to other sort of a Q&A. I'm going to probably be a little bit nice to you guys as well, and the viewer and the listener as well. I might just share, with your permission, if you don't mind, a little bit of my own personal investing and development story, but I'm also going to share with you guys a little bit about, how to structure your property investing, property development to minimize tax, but also maximize the profit. But I'm going to share with you my own personal approach where I use my own strategy and structuring. I'm very similar to some of my clients doing it as well in terms of helping you to be more confident. Most importantly is I'm going to share with you also and the audience in terms of the most important and the right questions, but the smart question that you should be asking to your accountant before you even embark in property investing, property development. So look, at the end of the day, if you follow this, you have a great ability to minimize tax, but also much more opportunity to achieve the successful outcome. Okay, so I'm gonna just probably jump on share screen at the moment and begin a bit of sharing with you guys. Okay, I'm gonna just start really quickly. as I said, tonight we're just going to probably be focused on sharing with you guys the actual structure approach to actually property investing and development. So ultimately, we can either maximize your wealth or minimize your tax. One of the things that I'm passionate about that I want to share with you guys is some of the fear. Often clients coming to see me and investors, what are they fear of? And really, sometimes what they're fearing is actually not making enough money or no cash flow in the investing. Alternatively, if they're investing in property development, there's a fear of maybe getting ATO audited because either they don't get a right tax advice or taxes not being accounted for, such as GST. We're going to talk a little bit about GST and taxes and definitely property, right? The other thing that I am hearing for a lot of the investors and the viewer that coming to see us also is that sometimes a prospective client or even our existing client, one of the things that they are really, really frustrated about, I think we talked about that before, is that they fear about actually getting the wrong structuring. And the wrong structuring really just meant that getting the wrong structure can be really confusing, right? Because a lot of the time, a lot of people hold back in terms of buying in a name, in a company or in a trust name, just not sure whether it's the right structure, particularly focusing on the outcome and the current situation. So those are one of the things that clients are often worried about, is getting the wrong structure. Now, if you're actually getting the wrong structure, if this happens, people often worry about a fail of building their property portfolio, whereby sometime you could be stuck with the cash flow or actually unable to get more finance because of the way that you're structuring your ownership. Alternatively, just continue to grow your portfolio in terms of retirement. Okay, so those are the two, probably some of the basic structure frustrations that we come across as well. Now, the other things that I want to do, I mentioned to you earlier on, is to ask really, really super smart questions about when you actually invest. I'm gonna share with you a bit of a story that you mentioned about how prospective investors coming in, either be a developer or investor, they often go and see an accountant, and I want to make sure that have they got the right structure or what is the best structure. So today I am actually going to be a little bit advising. So I'm not going to tell you what is the best structure for the viewer or the listener, but however, what I want to do is talk about what are the options of a investments or development structure available, such as individual company or trust name or even SMSF, or what are the tax implications on each structure. Okay, so some of the smart questions that I guess the viewer and also I'm helping and educating some of my clients are actually teaching them in terms of asking us smart questions. First and foremost is that you want to sort of basically ask a smart question, particularly as a property investors and developer. One of the things that you got to look at is that you might want to ask a question, particularly when you go and see an accountant or even coming to see us, is that the first question I actually ask is that I want to know that if you are going to enter into a property investing and development, what you want to know is that you want to know what is the actual ultimate intention and why you're doing what you got to doing, right? Are you actually investing or are you actually developing? So make a big distinctions between investing, being long-term holding, or development, where you have a shorter time span. Okay, so that's the first question. You want to be asking what are the intention if you are investing. So any good accountant or advisor will probably want to know, firstly, what is your intention, and are you investing in a short term, or are you on a long term, or are you actually developing? Okay, so that's the very, very first question I probably usually tend to ask my prospective client. Now, the second question I will proceed to ask my client in an interview or in an actual initial discovery meeting would be, how is it that you intend to get out on the deal on a project? Yeah, are we on the same page? Yeah. So first question is what's really your intention, but second one is, once you get into the project or the investing, how do you intend to get out? So as an investor, you probably want to hold it long term. That means you might want to think about the cash flow and the capital gain tax in the future when you eventually sell it. Alternatively, if you're a developer, you kind of think about the opportunity, whether or not are you actually going to sell some or keep some, or sell all or keep all. So those are important second question you should be asking. What is your intention, particularly in relation to the exit strategy? Okay. Now, the third question, which is the most important question, that why we're having this discussion tonight, is what entity do you intend to purchase a property in? Right. When I mention entity, I mean ownership structure, particularly in Australia. Are you intend to buy in individual name as a sole individual, husband and wife, or are you intend to buy in a company or a trust structure? So I'm gonna sort of dive in a little bit, not too much, on what are the available options of when you come to buy property investing and development, either in an individual name or a company or trust. So those are the three probably most important questions. Now, the final probably most important question, which I find either investor or a developer often sort of a missed or kind of leave it to the last minute, is questions that you need to think about. When I finally completed my project or buying and selling or investing in development, how is the actual end proceed? The money is going to come out of the ownership entity, being either individual name, in a company name, or in a trust name. So we decide that we have an intention, whether we buy or investing or developing. We then basically decide that when we do eventually get out, either as a selling as a long-term capital gain, or we sell it immediately as a property development for project conclusion. Alternatively, we then look at it and say, well, if we decide to buy in a particular ownership structure, entity name, company, trust, or individual, how is the money going to come out? Because it makes a big difference to considering that how does the money come out? Because that's the point where you got to consider the tax implication. Okay, so those are the four most important questions that we definitely need to ask. Okay, now we're gonna circle back in those questions. I'm gonna actually use some of those questions to, I guess, share with you in cooperation with my own story, my own development, so that you can actually see that every question has been calibrated, has been considered. So then we also understand the actual outcome and the actual result out of it. Okay, so usually when I see a client, particularly a prospective client coming in to see me, we want to know exactly where it's probably fair to find out, get to know the client, right? What's really important to the client, all right? What do they want? What do they want out of the meeting? What are the goals? What are they trying to achieve? And what is really, I guess, important to you as a client? So we look at like where you are now today and where you want to go, and what do you actually have financially? Like how much money you make, what equity do you have, what are your serviceability? Have you got money in super or particularly for retirement? So when you look at that, you want to know exactly where you are today. And most importantly, also, Nathan, we need to know also as an advisor exactly also where is their client heading, like where they're going, right? So if you look at this particular gap in future, we're talking about if you're 45 today, where would you like to be in the next 10, 20 years? Now, the reason I do drifting is that if you've got no plan or you fail to plan, time flies really quick, right? So in the next 10, 20 years, you'll be drifting away. You'll be looking at from a crisis or a area where you cannot fund your own self-funded retirement, right? But if you have an action and you have a plan, you take proactive approach, you've got intention to create the wealth that you want, and your ultimate objective is financial freedom and passive income, then you need to start thinking about, have you got a plan, right? So that's what we're talking about. If you plan for the future, you need to know how much money do I need in the future in order to create the passive income that I need for my tomorrow retirement. Okay, so first thing that we're going to look at is that we're talking about strategy, right? Strategy is so important. One of the pillars that we always focusing on, the first and foremost is strategy. What sort of strategy do you actually use a vehicle to achieve from A to B, from where you are today to where you want to go, so you can achieve that financial freedom? So strategy, we're talking about, are you buying property, renovating, building a duplex, earning a passive income, or creating the wealth through growth and equity, right? The second things that we talk about, so strategy, we mean property and real estate, meaning, are we buying a property as a buying whole or buying developing? Okay, so that's what we mean about strategy. Now, the second thing that we talk about is structuring, which I will probably delve into a little bit more in detail when I share with you my own property development strategy and structuring, whereby we're talking about, are we buying an individual name, or are we buying it in a company name or buying in a trust name? Because when you buy individual name, in a minute, you'll see that the individual have individual tax rate, a company's got a company tax rate, and also a trust, it's got its own flexibility. Trust doesn't actually pay tax, right? So all the profit get distributed to the actual beneficiary, and the beneficiary actually pay tax. So we talk about that, the taxing side of it, and the two types of tax that we actually need to sort of discuss a little bit as well. So the second part, after we talk about strategy, what is the best strategy or the right strategy that you are deploy to actually achieve your financial freedom? And the second one is, how do you structure? Are you structure for today to minimize tax? or your structure for tomorrow, for financial future, for retirement. Okay. Now, and the third one is obviously something that we are specialized on, and something that we have an expertise on, is taxation, right? So we're going to talk about a two type of tax probably today, just with the limit of the time for the audience. We're probably going to just touch on a little bit heavy on maybe GST, and income tax and capital gain tax. There are other lot of tax in a minute you'll see, but we're just going to touch on those. So that's what we're talking about. Strategy number one, a structure. We're using company, individual, or trust. We're going to touch on probably a little bit SMSF. I know you bent my arm a little bit last night saying we're going to share something on SMSF, because it's obviously very, very topical today, right? Well, this season. Okay, so the other thing that I remember often talking to you is that after we talk about strategy, is that we often sort of talk about, well, strategy is a strategy that we're going to be generating cash flow today. So it's a passive income for some people that might be a baby boomer, a high net wealth, or individual that basically want to have a bit of a supplement income, where the individual might not want to work, in exchange for job or salary wages, but they want to make sure that they enjoy what they do as a professional. But they also want to make sure that have they got a security or financial confidence that I got an asset that will generate cash flow for me now before I hit retirement, right? That's passive income. Alternatively, there are baby boomer, and there's no doubt there's probably a listener there already on retirement. They're looking for cash flow where they don't work anymore. So they need that passive income to fund their lifestyle, to do whatever they want to do, so that they have a choice in life. They can spend time with their family, or do what's most important to them. Now, here's the thing. You need to think about if you're going to have a cash flow today or tomorrow, particularly when we talk about structure matter, because if you structure it wrongly 10 years ago, right, 10 years later, when you hit your retirement, if you don't structure it correctly, then you start paying tax implications will come through. Now, so the thing that we're going to talk about a little bit is that why structure become matter when it comes to wealth building now and in the future. Alternatively, tax implication. If you got the wrong structure, shortly you'll see the example. You're probably paying a top marginal tax rate in Australia, and obviously, we're living in a world of wanting to make sure we protect our hard-earned money, not so much as asset protection from creditor, but more so protecting your hard-earned money for the next generation, which is what a lot of wealthy people kind of worry about when they got a lot of money. How do I hand over the money to my next generation to make sure that all my hard-earned asset that I built is actually protected, but also handed over as free tax as possible. Okay, so these are the structure that we're going to be talking about quickly. Now, so when we talk about property investing, property development, often we talk about structure. Structure meaning, are we buying in a company name? Are we buying in a trust name? And there's a little bit more complication way, is that we're talking about also the joint venture, which we're not going to touch on tonight, because that's a subject on its own. So that's the first thing you got to do. So as an example, if an individual, you can always buy property in an individual name, and you can actually buy in investing and sell it, or buy, develop and sell it, right? So remember I said to you earlier on, the first question you've got to ask is, if you've got an intention to buy into investing or development and you're going to see an accountant as an advisor, the very first question you want to ask, remember what I said to you, right? Is that, you got to ask the right questions, right? So one of the questions we did ask is that, what is your intention? Now, so let's say as an example, if you are buying a property and you buy it in your name, and if you look at this taxing rate at the moment, so these are the four opportunity that you can actually buy under, right, as an ownership. Now, let's say if you buy a property in individual name and you ignoring, the tax minimization opportunity and the fact that you don't care about ability to buy more property or affecting your increased capacity to service another property acquisitions or even protecting asset. Now, here's the tax rate. Here's the tax available, or that you need to be aware of. First and foremost, we're going to be talking about the three type of taxes, right? There's actually two types, not three. So the first one is an income tax. And the income tax will be a tax on a personal right or the individual right. So personal right that we're going to be talking about is this one here. So individually, if you actually got a job, and most average Australian do have a job, or you work for yourself, you pay yourself a wages. So these are the actual tax rate, and individual, you absolutely cannot get away and avoid it, right? These are the individual tax rate. Now, when you look at this table, what I actually want the viewer to take away from this table, which is really important, is that I got a lot of clients asking questions that if I'm actually earning $130,000, does that mean I'm going to pay 30% entirely over the whole 135 grand? You can see that the answer is actually no, right? Because when you earn 130,000, the first level of say 18,200, you're actually paying no tax. That's what we call the tax-free threshold. Plus you got some rebates and low income tax refund, right? Now, the second rate you're paying as an individual is anything that you earn up to 45,000 will be taxed at about 16%. So 16%, it'll be the tax rate that you'll be paying from 45 minus 18,000. And the next tax rate, so on, from 135,000 less than 45, that will be on 30%. But here's the thing. So what the viewer that need to take away is that when you actually earn 125,000, your actual effective tax rate is only 25%, right? Not even 35%. So that's the first most important thing that viewer want to take away, that even if you're earning about 125, even if you're earning about 250, the actual maximum tax rate you pay between 125 is only no more than 25%. So it's not 30%, okay? So now that you understand that as an individual, if you got a job earning about 50, 100 grand, you will be paying already 20%. But if you're earning 120, right, 25, you'll be already paying 25% tax. Now, here's the thing. If you actually choose to buy a property in an individual name, or be it investing in individual name, or be it developing an individual name. So don't forget, by the time the project completed, the project that you finish, you'll be, say, buying it for 500 grand, selling it for $1 million, right? Now, if you're actually carrying on the enterprise in property development, you actually make $500,000 profit, right? Buy for 500, keep our math really simple for today. You're selling for $1 million. $1 million minus 500, you're actually making $500,000 profit. So if you carry on the enterprise, that 500,000 is actually going to be levy adding on top of your individual name as income tax. So if you already got 100,000, right? 100,000 plus another 500, you're going to be on $500,000 plus 100,000, which push you to a marginal tax rate. So you're going to start thinking about the tax implication on how much tax you got to pay as a tax on revenue, right? Now, the other tax you got to think about is that if you're actually not developing, you probably end up doing a property investing in long-term holding. That means you're buying it and you hold it long-term, you're selling it. So that's capital gain, right? So if you sell it for $1 million, more than 12 months or some years later, the 500,000, you minus the 50% CGT exemption, and that will give you probably roughly about 250. So even that, you still got to have your net capital gain 250, adding on top of your current salary wages, which already be taxed at 25%. So now you start thinking about, if you had bought it in a company trust name, you got a lot more flexibility to manage your tax and pay at a corporate tax rate. Why? Because the company tax rate, you can see, is only be 25%. Whereas individual tax rate, you'll be paying maximum 45 plus a levy, right? Medicare. So that's the first and foremost when we talk about tax. Now, the other thing we've got to talk about is that if you are actually an investor, you can almost completely forget about the GST, because GST doesn't apply to property investors buy and hold, yeah? But if you're actually a developer, you do need to think about the GST implications or the importance of understanding when do you have to pay GST. So GST is only applicable to you if you're buying a property, you're developing it, you're turning it into a new property, you're selling it, and carrying on the enterprise as a developer. So you do have to think about paying GST. Now, the good news is you have to register GST if you're actually selling any property over $75,000 anyway. And therefore, if you're registered GST, you can claim GST input tax credit on all your building and development costs and everything, right? So that's a GST. It's really just not cost of doing business. You just got to be aware of the obligations of actually understanding when you are required to register GST, or whether or not the property development that you're actually developing and selling is actually required to pay GST. So those are the two taxes we're talking about. The income tax will be basically a tax on revenue or tax on capital gain, and a GST will be if you actually carry on the property development. Now, there are other tax you can see. If you're holding the property, the local government will charge you a rate and charges. If you're buying a property, or even any local jurisdictions, you have to actually pay stamp duty. And finally, like every states and territory, if you're holding a property, even developing during the financial year, you actually will have to pay land tax as well. So those are the tax on property. I'm just going to move on really quickly on, I think we talk a little bit about, sometimes the viewer just want to know, particularly in Australia, and if you've got an overseas viewer, but this is in Australia as well, what are the tax applied to you when you buy property, whether it be investing or development? So most of your viewers already know this, that if you're buying property, the first and foremost, whether you're buying, investing or development, you got to pay stamp duty anyway, okay? The other one is that the land tax, which is going to be another sort of expense that you now have to actually be aware of to incorporate in your cash flow, because it happens every year. So it doesn't matter what territory or state you're in, particularly in Queensland and Queensland, New South Wales and Victoria, they've got a higher land tax threshold. Now, I think if you're lucky in either in Tassie or Northern Territory, you don't have land tax obligation there. Now, when you do sell it, and we mentioned a little bit about if you're a property developer, you'll be basically taxed on income tax on revenue. But if you're actually investor for holding it for long term rather than 12 months, you'll be basically taxed on the capital gain. What it means is just 50% will be taxable instead of a whole 100%. Okay. We touched on a little bit GST. As I said, if you are selling it where you're creating a new product, a new sort of property subdivisions or brand new units and apartments or duplex, you will need to pay GST if you're a developer. Okay. Now, just the really quickly, we mentioned a little bit about putting all together the 4 questions. We talk about what is your intention, right? How am I going to exit the property? What is the best structure and how do I get money out? So remember, we talk about strategy. So one of the strategy is that instead of creating a cash flow, I got flexibility. If I want to sell it, then I got a cash flow. If I want to keep it, I actually got a capital gain. Now, equity, right? Meaning growth. So part of the strategy is that we actually buy a property that can subdividable into 1, 2, or 3, and then we build them like duplex or townhouse or even apartment. I'll keep this little example shortly simple, but this is actually one of the real life example that my brother and I do, where we buy a property close to CBD Brisbane, about 10K, in a suburb called Jurunpili and Taringa. So these are real life 2 example. Remember, as I said, first and foremost, our strategy is to either buy to sell with a cash flow for a profit, or we'll keep it for capital growth and hold it and for future, right? So the way that we done is that number one, we know exactly what our intentions are, and then we're looking at buying it, creating equity, building it, getting DA, building it, getting it value. So let's say if we got an end valuations from, say, $8.5 million when it's fully completed in about, say, 1 or 2 years, what we inevitably ended up costing us is about probably $8.7 million. So we actually create an equity of 1.5 million, or if we do sell it all, we're going to be creating a profit of 1.5 million, right? So if we sell it, we have to pay a lot of tax. If we keep it, then obviously there's no tax to be paid. So the way we have done, this is some basic example to share with you, that we got skin in the game and we're doing it as well. But look, so the way we structure is this one here. So we bought the first property. Again, this is not a tax advice or the best structuring advice for the viewer. This is just based on my current circumstance, my intention, my outcome, my objectives, right? So we structure under company trust structure. Number one, we obviously want asset protection. Number 2, we want really flexibility in distributing income to our low income family member. Number 3, we want to make sure that if we do decide to keep it without selling it, we want to keep it in a structure that have giving us also future taxation flexibility when we do eventually sell it. Number 4 is we really want to keep it separate, so it's a lot easier to get finance as well, okay? And not having all my property under one structure. So I structure it that way. Project number 1. Project number 2, be it again, if I keep it or sell it, I basically structure it under company trust structure. Now, if I eventually do sell it, I'll be taxed at the income tax level, which is tax on revenue, right? Remember I said to you, if I do go and see an accountant, this is my first project, often the accountant will say, it's so simple, you got no asset protection, you got no need for taxation, just buy in your name. But here's the thing, if I happen to be successful doing this project and I'm going to make a lot of money, I don't want that profit to be taxed on my personal name, right? Because I'll be paying at a marginal tax rate. So if you're buying it in a company trust name, number one, in a trust, you've got flexibility in distributing the profit to your lower member family income. And number 2, you can put it into a corporate beneficiary or a bucket company where the maximum tax rate you pay as a small business-based entity is only 25%. So you can see the difference of highest marginal tax rate being 45 and a flat tax rate at 25%, right? So those are the reason that we use company trust structure, and you can see the flexibility. Now, finally, if I then actually want to pay myself a bit of project management fee or property development fee, I can set up a different trading entity that actually charge my own project. That is, if I fully blown property development project, right? I can pay myself a bit of a project management fee. Obviously, I've got to pay tax on my income. And then ultimately, if I want to reduce my tax, I probably put some money into super to maximize the optimizations or the contribution rule, so that I can actually tax at 15%. In a minute, we're going to touch on a little bit about super, tax on super, and also how to use super to actually invest in invest in property with an SMSF. So that's basically my strategy and my structuring and how I handle my taxes. Remember, I said to you, first and foremost, what is my intention? My intention to create wealth, either cash flow or equity. So that's how I do it. Secondly, we're talking about, have I got an exit strategy? Yes, if I do want to get out, I'm aware of the actual profit that I've got to be earning and I've got to be taxed. And thirdly, what are the structure entity? I use company trust to help me to acquire the property as the ownership. And then fourthly, if I then need the money coming out, how does the money come in? Well, the money will go to my beneficiary kids and family member. Once I use them all up at a lower marginal tax rate, I then have the ability to distribute to either superannuation or a bucket company. So that's how I tackle the 4 questions. Okay. So hopefully we're on the same page. We're rolling it really, really quickly now. So this is the actually my own personal master plan structuring mapping that I share, that I've been having for the last 25 years, that I pay a really good advisor and a big law firm give me advice on how to actually structure. So often I have my own company trust structure, run my practice, run my consultancy arm as separately to my investment company. So you can see the second company will be my property investments, where I'm holding it under a company trust. And then our own building, we own it in a company trust and superannuation. And then finally, we got duplex as well. Thanks to your guidance. And we actually do something similar where we have duplex in place, where we structure it so that there's a cash flow coming in to support the payments of other sort of a hungry property holding entity that's costing me money. And finally, we got property development, where we might have sell some, so then we're going to pay tax from all the one that we sold, but we end up keeping some, so then we turn it into capital gain. So that's just my overall master plan structure. Okay. So we're talking about the future. Remember, the gap is where you are now, right? And what do you actually have, and how are you going to actually get to achieve your goal? The future will be, what do you really need to generate the income, the passive cash flow that you need to live a good life, to satisfy your desire and your financial freedom. So you can see that if the viewer, as an example, is 45 today, you work really, really hard to develop the strategy, structure correctly, right? And manage the cash flow to hold the property. In the next 10, 20 years, as the property grow, you might want to sell the property. You might want to enjoy the cash flow. So as the property grow, you might want to sell some. So if it's in your name, you got to pay a lot of tax, because it's in your personal name. You've got very little opportunity to minimize your tax, right? Because there's no flexibility. But if it's in company trust structure, I can actually distribute the capital gain or the cash flow to my family member. And if it's in super, in a minute you'll see it. That's the kicker, right? It's get better. Where basically that's where you see you pay very, very little to no tax at all. Okay, so that's basically everything we're talking about, how to actually, like getting the right strategy and the right structure, the best structure, or the right structure to your particular circumstances, right? And how to actually manage your tax along the way. Now, the often our viewer and also our prospective client, or even our client, will talk about, if we're actually investing already, outside super in a company trust individual name, I thought there's an opportunity that you can actually structure inside super, where you can use your super to buy property with an SMSF. You're absolutely right. Right? There is the last structuring approach that you can actually use your super to buy property with an SMSF. Enter superannuation or SMSF opportunity, which is the hot topic right now, right? So first and foremost, right, superannuation actually taxed differently, right? So, and I'm not sure a lot of the audience actually even aware of it, right? Here's the thing: when the money comes into the super, it'll be taxed at 15%, be it rental income or earnings or your contribution, right? If you then buy a property, hold it for more than 4 months, you sell it, it's a capital gain. Here's the thing, the capital gain only tax at 10% during the accumulation phase, particularly if you're under 60, right? Now, here's the good news, right? And the kicker, if you live long enough, and most people do, over 60 or 65, when you actually retire and your super or be an SMSF in a pension phase, you'll be actually, all the earning coming out, right, is tax-free, which is your rental income and your earning. Now, this is not excluding if you retire, but you're still working and you're still making contribution, that contribution will still be taxed at 15%. So first and foremost, super tax differently. Have a look at this table that we put together from our last presentation, where it clearly show, the different tax rate on the actual positioning, be it before retirement, after retirement. You can see that if you actually buy property in your name, whether it be you're under 60 or over 60, you still have to pay tax at all the time, every time, right? If it's in a company, you can almost guarantee that, all your earning will be taxed at 30%. Particularly, trust don't pay tax because the beneficiary actually pay tax. But if you look at towards the right hand side, if the superannuation under an SMSF or superannuation, all the earning will be taxed at 15%. Okay, if it is in capital gain, you'll be obviously taxed at 10%. But here's the kicker, right? You look at the pension phase, or when you're on a retirement phase, all your earning, including your capital gain, is taxed at 0 tax rate. Okay, so this is why you got to start understanding superannuation is actually taxed differently. Now, so why do people, investors actually think about, why property is so powerful for wealth creation, right? And as you always sort of alerted to me and our client as well, first and foremost, property are bloody great, good for leveraging, right? You can have a 1 in 90% leveraging as compared to share, right? Second most important thing, that I think we, as Aussie as well, I'm as Aussie as you, we love property, right? Just the DNA, as Australian sort of a DNA, good old barbecue, right? Steak, what do you call, like bacon and egg, right? You can't have the bacon without the egg, right? Well, property is the same. You can't have the share without the property without the share, basically. But the difference is, they all have given you different ability to leverage and growth, and taxes doesn't matter. You have it in a share or property. Tax comes in, and the reason in a minute you see why tax is so important when it comes to structuring, right? So that's the first things that we use, property as being a powerful vehicle for wealth creation. Now, the other thing is that I remember you're always asking me a question. So look, Tony, here's the thing. That's a special slide just made for you, my friend, right? So remember, you always say, look, what are your clients telling you, right, about their direct investment into property using SMSF, right? So we because of you, we actually done a little sort of Q&A and also a bit of a survey as well. And here's some of the finding from what the client is telling us as well, and some of your guys are telling us, is that first and foremost, right, clients are saying that I want to invest in direct property via an SMSF simply because I have total control. I got more control in my own investment strategy, right? So that's the first and foremost, right? The second one is we talk a lot about taxes, right? Well, isn't it obvious that SMSF or even super giving you a lot lower tax rate, be it 15 or 0 tax rate, right? Now, and the last one I think is really important is that you can actually grow your superannuation, right, in an SMSF with your investment choices, but also make, the maximum superannuation contribution, where all the contribution you made, subject to maximum new rule today, I think entering the 2025 financial year, is about 30,000, right? So you can actually contribute 30,000 and only get taxed at 15%. Whereas if you're earning outside super being 100,000, you can see the example, even at 125, you'll be taxed at 25%. So it makes sense that you want to make salary sacrifice and start investing and save money to put into super, because the money going to super are not only taxed at 15% at a concessional tax rate, you're saving 10% straight away. But on top of that, you can fast track reducing your debt inside SMSF, your loan. And here's the good news. In a minute, I'll use an example to show you. You can pay down your loan so quick. So when you get to that retirement, you got no more debt and all the income coming out, including capital gains, tax-free, right? So that's a special slide, just done it specially for you, my friend, okay? Hope you like it. But anyway, you get to share with me once you unmute yourself. Now, so the other thing is, I think one of the things that we fascinated about, right, being an SMSF specialist advisor is that when I started, I don't know if I mentioned that to you, Nathan. You couldn't believe it, man. Yes, I started, 25 years ago when I was 10, might as well do your sum, right? Mate, you couldn't believe it, right? When I started, the SMSF was only around 25,000, right? So that means there's only 25,000 structure 25 years ago, right? Fast forward to today, 2024, guess what? If you check on the ITO database, there's absolutely over 610,000 SMSF set up. Now, here's the kicker, right? Out of that 600,000, the ATO is saying, statistically, the average trustees and average trustees member got about $1 million in the fund, right? Compared to the retail fund, where you got a male superannuation balance is about 400,000, right? And a female is about 318,000. All right. So this is just something, that we've done a bit of a statistical sort of investigations on. But here's the thing. So why is, the current sort of a space in the actual superannuation SMSF becomes so sort of exciting at the moment? You can probably see in the last 6 to 12 months, right? Where superannuation and SMSF and property has been sort of talk of the town. Now, one of the things is that you can see the amazing advantage of an SMSF is that first and foremost is that not only you have a better control of your financial destiny and your future retirement, is that you can see that there's a far more tax-effective concession in an SMSF, right, with the super. And the other thing I think is really, really important is that when you actually have a retail fund, is that your fund and your partner's fund or your brother and sister, they're all kind of scattered everywhere, right? They're not combined as an investment, as one sort of opportunity to invest together. So one of the things that it can be good or bad is that, you with the SMSF, you got an actual opportunity. You can combine the husband and wife and brother and sister spouse together up to 6 member, where you now got a larger pool that otherwise you can actually buy a property you couldn't afford to buy, but now you can actually borrow as well, right? And buy a property in an SMSF with your super. So one of the things that is important is that you mentioned about, well, okay, what are some of the property that if I got sufficient super and I'm interested in considering using SMSF to buy a property with borrowing, and I think one of the things that some of the questions you'll be asking will be, so, well, Tony, what sort of type of property that can my SMSF or can my superannuation buy? And one of the things that you can do in terms of residential property, the type of property you can buy, first and foremost, which is something that you're super specialized on, is your duplexes, right? So SMSF can actually buy a property such as duplexes, apartment, townhouses, or house and land package or house, right? The existing one or brand new one. Now, if you are an entrepreneur, business owner like you and me, we definitely can buy our commercial property, or we specialize on a lot of high net worth individual and professional like doctors and dentists, practitioner owner, right? So they can actually buy practice premises on property that they actually operate from. Like we operating from my own building that I'm actually owned by my SMSF as well. The other really, really good one is that over the probably past 10, 20 years, we see a lot of client actually got residential property where they actually run a business premises over it, right? From it. So as long as it's 100% exclusive operation from my business, we could actually classify the property as being business real property. That means your SMSF can actually buy that property from you if you do have one. And finally, you got industrial and warehouse and so on, right? So those are the type of property you can actually buy. Once we sort of open up the forum for Q&A, I'm more than happy for you to sort of discuss a little bit further. Now, I'm just going to take you through a little bit more on how the actual SMSF strategy structuring works, where you need a company as a special purpose vehicle, trustees for an SMSF, which is basically a trust. If you are going to do borrowing, subject to the borrowing rule, you do need to have a special holding company or holding trust, which is sometimes called a bear trust or custodian trust, to hold the property, to separate the ownership. And the bank will lend you the money based on the structure. If you don't have the LRBA or the actual holding company, holding trust, the bank won't lend you that money. Okay, so based on this, as I said, when you're using your super to buy property in SMSF, one of the benefits you get is that when you actually get to the end, being retirement, you'll be able to enjoy the effective tax rate, very concessional rate at 0 tax rate, subject to obviously the cap limit 1.9 at the moment, right? And as I said, the more money you put it into super as a contribution, being taxed at 15%, sometimes even lower if you've got a brand new property with depreciation, right? And you can actually use the remaining net income from your rental property to pay down the debt. So those are some of the benefit there. Now, this is actually, as an example, real life example that I'll share with you that we did probably about 10 years ago, where just for the sake of the protecting the innocent's name, let's call them Jack and Jill, right? That's not their real name, but so these two individuals come in to see us 10 years ago. They got 350 grand in super. They're both earning reasonable good income. And so one of the strategy, and this is what we're talking about, the sequencing strategy, is that you don't just do your basic normal contribution from your employer anymore. So what we do is we maximize, we do our financial planning, we look at where you're at, where you're going, how much can you budget, how much can you save, how much can you service, how much can you put it away. So in terms of how much we can put it away, we worked it out that gradually we can actually max up the super contribution. That's when the superannuation rule sort of maximum contribution cuts off at $25,000. So we max up the super contribution, and so we bought a property for $650, right? And basically we only have $350,000, so we don't have enough money. So we got to go to the bank and borrow the balance of it to fund the actual complete acquisition. Fast forward to 2024, you look at this here. If you do an RP data search or a property search, this property right now in Queensland is actually worth about 1.5 million. So that's only 10 years ago, right? Now, here's the thing. So this is a beauty. Look at it, right? So about 10 years ago, the individual will buy this property for $650, renting at about $750. Fast forward 10 years later, we were predicting, probably double every 10 years or at least, 15 odd years, right? Growing at around 5-10%. But watch this. So we are now at 2023. We're not even at 2024. But the property is actually worth $1.5 million, right? And now here's the thing. The individual's already 65 years. So we put it in pension. The debt's all gone, right? The property, if you sell this property right now at 1.5 million, you now got 1.5 million financial confidence in your bank account, right? That you can actually, have a plenty of cash at the bank. Now, obviously, if it's in pension, the money comes out will be tax-free in terms of earning. If you do sell it, capital gain will be tax-free as well, okay? So you can see that what SMSF can actually help you. I guess my takeaway on this one, really to share with the audience, is that when we talk about structure in your name, in a company or trust, and an SMSF, you can see quickly, if you structure in your name, often the ultimate tax implications or the outcome is that you're going to pay a lot of tax, right? There's not much of the money you can hold. But if you have it in a company, you only have to maybe pay a maximum flat tax at about 25-30%. But if you have it in a super, you can see there's a lot more money for you to keep at the end of your achievement or your financial success. And ultimately, when you now enter into the future where you're now enjoying your financial freedom and your retirement, that's where you want to make sure all the money sits in a tax-effective environment, okay, the structure. Okay, so I've just got a few more maybe slides to share with you, and I probably stop sharing on that. You can see that structuring is so important and it matters because you've got to think about 10 years ago, whether or not you got money outside super, inside super. So if you've got a lot of money outside super, you can obviously start the project in company individual name or trust where you start accumulating wealth and making money. But using company trust, you can see you've got a lot more tax effectiveness and what we call a planning opportunity, and also are able to borrow more money. Now, but if you have it in a super, later on, it's actually get better because the money coming out is tax-free, right? Now, there is a bit of a fine lining in terms of trade-off where if I put money into super now, sure, I don't get to use it. But this is what you want to do, right? You want to start saving money into the future. So the more money you save in the future, because that's where you want to be. You want to make sure you've got plenty of money in the future. So when you do retire, you're going to be able to have that financial confidence to make sure that you can live a beautiful life so that you can financially free, having that passive income. So that's why I said to you, when you do buy a property today, you got to ask the first and foremost question, what are the intention? So the intention is for financial future and retirement. Putting in your name, probably not very smart. So you got to get the right advice and making sure you ask the right question. So that's that there. Look, I do have a few more strategy here, and we can open for Q&A a bit later on. So one of the things that I like about SMSF, as we sort of discuss often, is that it often actually provides you a lot more sophisticated and flexibility in tax planning, right? And tax planning is so important, particularly high net worth individual and retiree, particularly if you got asset outside super, you still need to have some kind of a tax planning. And tax planning, actually don't do it at the end of the year. You want to do it during the financial year, right? Perhaps often as maybe at least you got to have minimum twice in a year in tax planning. SMSF is wonderful at the moment because you can actually buy property with borrowing. And ultimately, if you got more money in super in the SMSF, you have the ability to diversify and widen up your investment sort of options, right? And SMSF, particularly for retirement income stream, as I said, is very, very tax effective. All the income coming out of the super will be tax free. Okay. So those are the strategy. Now, I won't probably go through all these. What I do want to go through is this particular slide about this one here. We talk about, remember, particular slide, we talk about having a leverage and growth and taxing. So without leveraging time and money, right, you got nothing to show for in terms of retirement. So meaning you got to save money, you got to leverage it, right? So you got bigger asset at the end, so that when you do hit the retirement, you got more money coming out. Okay. The other thing, as I said, remember I said to you, ask us smart questions, and these are some of the questions that we share with the audience, saying, well, if you are going to buy your first property, should it be in your name? Because it gives you more tax benefit. But have you considered the future tax implication, particularly in capital gain tax and inability to split the income between you and your future partner? Okay. Some of the other questions we talk about is that if you are going to buy in whole, particularly in the individual name or in a company trust name as a developer, what is the tax implication in terms of income tax or capital gain tax and CGT? So you need to think about all these tax sort of implication up front. Lastly, we talk a little bit about if you are going to create the wealth into the future and you want that passive income coming out, is it better coming out of the company because you already pay 30% tax, so you won't pay any more than 30% unless you're on a higher marginal tax rate? Or should it be in a super or in an SMSF whereby you pay no tax at all when the money comes out? Remember, we talk about how the money goes in, how the money goes out. Okay, so that's that there. Lastly, I think, for the audience, really, I think, you often teach me as well, structure or strategy is really, really important. And having the right structure really greatly benefit your future, because if you don't have the right strategy and the right structuring, that might have a bit of a detriment in terms of, in achieving what you're looking for in the future as well. Okay. Finally, look, as I said, you might think that I was saying that this sounds really great. What is the best structure, as I said, or what are the structuring options that you should be using to save tax? I always say there's no silver bullet, right? There's no one structure best for everything, right? So at the end of the day, it's personal circumstances, personal financial sort of situation as well. So at the end of the day, I would dare to say that individual just might want to see a professional and legal sort of expert just to make sure that you understand exactly where you're at. What are you actually trying to invest in? What are you trying to get out of it? What are the available structure that best suit you? And what are some of the tax implications that will tax now and into the future? And then the best structure will help you. You can see that navigate and minimize your tax obligation and protect your asset. Okay. Look, I think that's probably a little bit what I want to share with you guys.
That's terrific, Tony. Look, such a brilliant session, and I've got so much value out of this. What we're going to do, if anyone's got any questions, what I want to encourage you to do is send through the questions to our website, the residentialdeveloper.com.au. Feel free to comment on our YouTube or our social media channels. What we're going to do, I'm going to get Tony back on in a couple of months' time. We're going to do a follow-up Q&A and really unpack some key elements of when it comes to around to your development journey. Look, Tony, this has been such an insightful presentation. As I said, we'll in our next episode when we get you on, we'll go through a Q&A. But we're going to have a lot of listeners who are going to want to reach out, who are in the space where they really need to get some good tax advice and really want to develop a plan, like you said, for retirement to generate wealth. How can people get in touch with you off the back of this episode to really help them kickstart, just to determine if they're the right fit for you and vice versa? How can people get in touch?
Okay. Thanks very much, Nathan. Really appreciate that. And thanks for the opportunity to share with your audience as well. So to move to the next level, next step as well, often I basically want to ask questions And some of the questions we asked your audience, it will be like, are you okay, right? Can you live the lifestyle that you want to live for the future? So how we actually help the audience is that if we work with property investors and developers, and this is a couple of ways that we help. First and foremost, obviously, if you want a clear strategy to make profits in either investing in property development, if you want to actually have the right property investment structures or the property development structure, and if you want to get the right tax advice to make a smart financial decision. So we actually work with property investors aspiring either be 1 or plus property, or 2 to 5, or even more than 6 property, as well as a developer from 1 to 5 property, or even 5 to a dozen property development sites. So we work with a property developer, and this is how we can help. So how we do is that we work specifically with business owner and specialists, practitioner, doctors, and all that, just on a service provider. But also we specializing in just on the property investors and development and property personal wealth creation as well. Okay, but the other thing that we mentioned earlier on is that we're specialists in SMSF as well, so we can actually help audience with property acquisitions with a super, and set up the SMSF and administration SMSF as well. So one of the things that we can achieve in terms of working together is that we focus on the actual tax compliance, which is your basically normal tax return preparation from company, trust, and individual to super fund as well. But we also give business advisory, advice and strategy as well. Most importantly, we do a lot of property strategy and structuring advice as well, including wealth advisory and SMS administration. So those are areas that we can actually work together by helping your audience to actually achieve their financial goal.
Well, Tony, this has been a really brilliant session. I appreciate you jumping on, taking the time to put together such a wonderful presentation. I've got no doubt that our listeners and are going to get a huge amount of value out of this. So thank you all for listening in to this episode of the podcast. Look, once again, if you've got a lot of value out of this episode, Tony's details are going to be in all the show notes. We'll put all his details so you can get in touch with Tony and his team to help you on your investment development journey from a tax implication side of things, and really to help you generate wealth. And look, if you enjoyed this episode, I want to encourage you just to share it with those around you. Share it with family, friends, colleagues, fellow developers. Make sure you like and subscribe to all the various channels of this podcast. So thanks again for listening. We appreciate it. I'll see you next week.